Welcome back to the deep dive. Today we are doing a really critical follow-up. We're looking at a company that has, well, it's fascinated and frankly frustrated a lot of income investors for years. Sports Toto Berhad, or SPTOTO.
That's right.
We are diving deep into their crucial Q1 FY2026 financial report.
And this is a very timely discussion. I mean, we've spent a lot of time tracking SPTO's journey just through the last financial year.
We really have.
We charted that dramatic roller coaster, the surprising strength in Q3 of FY2025, which was all fueled by favorable luck and these massive jackpot wins.
Right.
And then immediately after, that drop-off in Q4, which raised some immediate red flags about volatility and, frankly, the unrelenting burden of their UK car business, HR Owen.
So now we have the first results for the new financial year, Q1 FY2026. This really is the moment of truth.
It is.
Our mission today is absolutely critical. We need to analyze these latest core figures, see if the volatility we saw last year was just a one-off, or if these deep structural issues are getting worse. And most importantly, we have to tackle that decade-long question that hangs over this stock. Why has SPTO continued this severe downtrend? I mean, falling from around RM4 back in 2013 to hitting RM1.36 recently.
It's a huge drop.
It is. And what is the actual realistic investment case for you, the income-focused investor, right now?
So we'll do a surgical breakdown of the latest figures. We'll look at both their high-margin, high-volatility core business, numbers forecast operations, or NFO, and then the non-core, persistently loss-making HR Owen segment.
And the cash generation.
A heavy focus on the most alarming data point, cash generation.
Yeah.
We have to understand how management plans to navigate macro risks, that massive bet, and the existential threat from the illegal gaming market that continues to siphon off billions.
Right. Before we unpack all of this, and it is incredibly dense, please remember to click like and subscribe to the channel. It really helps us bring you more in-depth analysis just like this.
It really does.
Okay, so let's get into the headlines for Q1 FY 2026. On the surface, if you just read the first line of the press release, you might, breathe a little sigh of relief.
You might think things are okay.
Exactly. Group revenue increased marginally, up 3.7% year-on-year to RM1.49 billion.
Sales went up. Momentum.
It sounds like momentum, but only if you stop reading at that top line. Here's where the narrative just completely flips, and it really demonstrates the extreme instability of this business. Despite that modest revenue increase, group profit before tax, so PBT.
What they earned before tax.
Exactly. It declined sharply by a devastating 34.2%.
34%. Wow. And when we look at what really matters most to shareholders, that profit attributable to the owners, the drop was even worse, wasn't it?
Oh, absolutely. That figure dropped a staggering 46.5%.
Almost half.
Almost half. So for every RM100 they made last year in Q1, they only made about RM53.50 this year. That revenue rise was just completely invalidated by the cost structure this quarter. That near 50% plunge it's alarming. So if we strip out any unusual one-off items to look at the true operational health, the core profit, what does that show us?
The core profit just confirms the grim story. It slipped 45.7% year-on-year, landing at just RM 20.2 million.
20 million.
And crucially, this result came in significantly below what analysts were expecting. Consensus forecasts, they were hoping for some stability, but this missed the full-year estimates by such a wide margin that it immediately forces analysts to just reevaluate their entire model for the company.
And it directly answers that first big investor question about core profit sustainability, doesn't it?
It does. Q1 provided a clear, sharp, and very negative answer to that.
So why this huge disparity? You have 3.7% revenue growth, but a 45% core profit collapse. We've seen this movie before with SPTOTO, and it always seems to come down to that one really unpredictable factor.
Is the luck factor, pure and simple. The core driver of this massive profit decline was a significantly higher than expected prize payout ratio in the NFO segment.
Right. We talked about this in our previous deep dives, how that favorable luck in Q3 last year artificially inflated their margins.
And Q1 FY 2026 gave investors the harsh inverse lesson. It's the other side of that exact same coin.
So let's talk about that specific number, because it really is the smoking gun. What was the exact payout ratio that just, decimated the profits?
The payout ratio hit an elevated 63.4% in 1Q FY26.
63.4.
Yeah. And, Context is everything here. Analysts note that this ratio is the highest level they've seen since the third quarter of FY23, so 2 years ago. This figure really highlights that inherent, extreme, and recurring volatility that defines this business. I mean, if the house has to pay out RM63.4 for every RM100 it collects, the margin just shrinks dramatically.
And that 63.4% is fascinating when you think about what analysts usually model for. What's the, quote, normal level the market expects?
Well, most analysts who track this sector closely, they tend to model a long-term prize payout ratio in the range of maybe 52% to 55%. You know, that range accounts for average winning frequency and ensures a healthy operating margin. So when you jump from a model 55% to an actual 63.4%, you're essentially handing back an extra 8.4 cents of every single ringgit in revenue to the winners.
And that flows directly to the bottom line.
It translates directly to profit compression.
That's a huge differential. When analysts miss the mark that widely, it really suggests the operational reality is just far more volatile than even the experts can really quantify.
And the primary implication there is that the sustainable EBIT margin, so earnings before interest and tax,
The profitability of the actual operation.
right, it's clearly highly exposed to these unpredictable jackpot cycles. I mean, investors, you worry about predictability, and Q1 shows that management has very little control over this key determinant of their quarterly earnings.
They can drive sales, which they did.
But they can't manage the luck. And if luck turns sour like it did here, profitability just vanishes overnight. It confirms that the biggest risk factor for SPTOTO is still external and, well, unmanageable.
Which, for income investors, who this stock often attracts, that kind of volatility is just brutal. It makes forecasting your dividend coverage almost impossible quarter to quarter.
You're forced to rely on the annual figures just to smooth out the luck.
Okay, so let's drill down into the segments, starting with that core engine. The NFO segment, run by STM Lottery. Despite the profit disaster, the top line for the NFO segment was, surprisingly, actually quite strong.
Yes, it was. The NFO segment performance showed, real structural health in its ability to draw customers. Revenue jumped a healthy 5.4% year-on-year to RM718 million.
So what was driving that?
Well, this growth wasn't accidental. It was driven by the one thing that still generates immense excitement in the legal gaming space.
The jackpot effect.
The jackpot effect. The force that temporarily defies gravity, as we called it last time. It was highly significant this quarter.
So how big did the jackpot get?
The key example is the Supreme Toto 658 jackpot. It just ballooned to an eye-watering RM78.5 million in the first quarter. That massive prize pool confirms that when the prize is big enough, it generates immense customer interest. It drives up ticket sales per draw significantly. So the product itself, when it's spiced up like that, it's still very appealing.
So we have a segment that increased sales by more than 5% because it executed its jackpot strategy. Yet the overall profit for this same segment just collapsed.
Despite that robust sales growth, the NFO segment's EBIT, its operating profit, it contracted sharply by 22.6% year-on-year.
22%.
This brings us right back to that margin compression. The 63.4% payout ratio compressed the NFO EBIT margin from 13.4% in the same quarter last year, down to just 9.8% in this quarter.
A drop from 13.4% to 9.8%. That's a 3.6 percentage point erosion of their operational margin.
Exactly.
So to put that in real terms, if the segment generated RM718 million in revenue, that 3.6% difference in margin is responsible for wiping out roughly RM25.8 million in potential operating profit.
And that's all due to bad luck. That RM25.8 million figure, it's illustrative, but it's the penalty you pay for high volatility. This quarter demonstrates that extreme dependence on the luck factor. It serves as a perfect textbook comparison to Q3 last year, where margins expanded because of favorable luck.
So the NFO segment is a potent sales engine, but its profit is just constantly tethered to a statistical coin flip.
That's a good way to put it.
Okay, now let's pivot to that secondary operation, HR Owen, the UK luxury car dealership. We've consistently called this a non-core liability. Did Q1 do anything to change that view? Did it address that structural drag?
In short, HR Owen remains a very serious drain. It recorded a modest 1.9% year-on-year growth in revenue, driven by higher new car deliveries.
Which sounds slightly positive.
Slightly. But it was immediately negated by the bottom line. The segment reported a pre-tax loss of RM9.4 million in Q1 FY2026.
Another RM9.4 million loss in a single quarter. And this is being offset against that highly profitable core NFO business. What's the specific operational problem here? Why does it keep losing money?
Well, the problem is fundamentally structural. I mean, you're selling highly specialized, multi-million-dollar assets, in a very volatile market. The loss before interest and tax, or LBIT, it was little changed at RM5.6 million compared to RM5.0 million last year. This poor performance is attributed to low consumer sentiment in the UK.
Right.
When global trade uncertainty and high inflation start to bite, high net worth individuals, they hesitate to spend on supercars. It's a very sensitive, very capital-intensive business to be in right now.
And it seems like selling supercars in a foreign currency in a volatile macro climate is just a constant operational risk that's so far removed from their core NFO licensing advantage.
And you can't forget the currency risk. That's another investor concern we have to address. The unfavorable foreign exchange effects when you translate HR Owen's GBP-denominated results back into ringgit. They continue to depress the group's revenue and profit translations. So even if HR Owen manages to break even in local GBP currency, a strengthening ringgit against the pound means that profit is literally reduced on the way home. It just consistently impacts the group's final numbers.
So it's another systemic anchor on their performance.
It is.
This brings us to what I think is the most worrying revelation of this whole Q1 report.
Oh, yeah.
The cash flow shift. I mean, cash flow is the ultimate metric for an income stock like SPTOTO. It's supposed to be the NFO's biggest strength, the bedrock of its dividend appeal.
It is.
But this quarter, that cash generation engine, it appears to have just seized up.
This point is a critical red flag. It addresses that investor question about cash flow and debt servicing head-on. Operating cash flow turned steeply negative. It reported net cash used in operating activities of negative RM 44.473 million in Q1.
Negative RM 44.4 million. For a business that is supposed to be a licensing monopoly generating consistent, predictable cash, that is a massive, shocking reversal.
And you have to look at the historical context. This is a significant reversal from the positive cash generated in the same quarter last year, which was over RM 34 million positive.
Right.
So even though the full year FY 2025 showed decreasing cash flow, swinging violently into negative territory like this, it signals an operational strain that goes way beyond just bad luck.
So when a traditionally cash-rich business suddenly reports negative operating cash flow, what does that usually mean? What could have triggered that huge RM 78 million swing from positive to negative in just 1 year?
There are a few likely operational causes, and this is where investors really need clarity from management. First, it could suggest significant pressure on working capital.
Okay.
Maybe they had an unusual inventory buildup at HR Owen, for instance. Second, it could point to high operational cash outflows that weren't immediately covered by cash coming in. This might involve the timing of those big jackpot payouts. The NFO segment accounts for prize money in the P&L, but the actual cash dispersal timing is what's crucial for operating cash flow. Maybe there was an accelerated or an unusually large payment sequence that just hit the working capital really hard this specific quarter.
So the company paid out a lot of prize money in cash, maybe even before they collected all the revenue, causing a temporary cash shortage. But isn't this exactly what management is supposed to mitigate?
Absolutely. While the NFO core generally generates robust cash flow over the long term, a sharp negative swing like this, it challenges that perception of robustness in the short term. It means the company burned cash in its daily operations this quarter, rather than generated it. And that is a severe red flag, especially for a company like SPTOTO that carries substantial debt that needs constant servicing.
Let's talk about that debt. How big is it? How does this negative cash flow impact their strategy to manage it?
The debt burden is substantial. Total borrowings stood at RM 1.507 billion as of September 30th, 2025.
$1.5 billion.
Yeah, and this liability includes significant long-term and short-term debt, and it's denominated in ringgit, Philippine peso, and the British pound.
So more foreign currency risk.
Another layer of forex risk, exactly, which just amplifies the concerns we had about HR Owen. This debt pile requires consistent, positive internal cash generation to service, which makes that negative RM 44 million figure fundamentally alarming for their ability to meet obligations without stress.
So management has to be aware of this. What's their stated strategy for tackling this debt, especially after a shock like this?
Well, management has confirmed that deleveraging is a core priority. They want to strengthen the balance sheet.
Okay.
So they're actively focused on a debt reduction push. Analysts are projecting that the net debt-to-equity ratio, which is a key metric for leverage, will decrease significantly through FY27.
So they have a plan.
They have a plan, and that commitment to systematic debt reduction is vital to reassure investors that the underlying capital structure is being managed, even if the quarterly luck is all over the place.
And just briefly returning to the external risks, How are they mitigating those recurring Forex and inflation pressures from their UK operations?
Well, the UK segment is the primary source of that currency vulnerability. Analysts tracking this have already adjusted their models, cutting their GBP to MYR assumption for earnings because of the pound's weakness.
Right.
And while management says they are constantly monitoring and managing their foreign exchange exposure, probably using basic hedging tools, the recurring negative translation effects from HR Owen show that these mitigations aren't entirely successful. The exposure remains a fundamental macro risk for the whole group.
Okay, let's move past the quarterly numbers to the bigger structural issues that have really defined this stock for a decade.
Right.
The first, and maybe the largest, is the competition from illegal gaming. This directly addresses one of those key investor questions.
It does. The illegal gaming market remains the single biggest weakness to SPTO's moat. It's an enormous problem that just dictates the limits of their sales and margin potential.
How big are we talking?
It's estimated to be 2 to 3 times the size of the entire legal market. So, we could be talking about potential revenue leakage reaching a staggering RM9 billion annually.
$9 billion a year just siphoned off. That figure, it needs to be repeated because it shows the sheer scale of the uphill battle. This is revenue that SPTOTO, with its monopoly license, should theoretically be capturing.
That is exactly the point. The scale of these illegal platforms limits SPTO's ability to adapt to digital trends because the illegal operators are often fully digital and unregulated. And it consistently squeezes the legal margins. They can offer higher payouts, they operate tax-free, creating this immense unfair competitive advantage.
And on top of that structural problem, you have specific regulatory headwinds.
Correct. The political decision to close legal NFO outlets in northern states, specifically Kita and Perlis, is expected to lead to the proliferation of illegal operators in those very areas.
So the legal market shrinks.
And the local consumer demand for gambling doesn't disappear. It just migrates to the unregulated illegal channels, which further fuels that RM9 billion shadow economy.
So given that the illegal market offers better incentives and is filling this void left by political decisions, what concrete strategy does SPTO management have to fight back? Is just hoping for a bigger jackpot enough?
The management strategy really focuses on leveraging their key strengths, the massive jackpot and the popularity of their digit games, to drive up sales per draw in the areas where they can still operate.
Make the legal product more exciting.
Irresistibly exciting. But they are also engaging regulators, and this is key. They're hoping to secure more than 8 special draws for 2026.
Okay, and why are special draws so important?
Special draws are essentially additional, highly profitable revenue opportunities granted by the government. Securing more than the usual 8 is a critical catalyst for revenue upside next year. It's a direct boost.
But is relying on regulator goodwill and statistical luck really a long-term strategy for winning back market share?
It really highlights the challenge they face. Since NFO operators are so restricted in digital innovation and marketing, they have to rely on these traditional levers. It's a defensive strategy, not really a growth one.
Okay, let's shift to the other persistent issue, HR Owen as that structural drag. Another investor question. The segment posted a RM9.4 million pre-tax loss. Why do they keep it, and what's the long-term fix?
That is the central question, isn't it? The HR Owen segment is foreign, it's capital intensive, it's exposed to entirely different risks, supply chains, tariffs, high operational costs.
Mostly property leases in the UK, right?
Exactly, in expensive UK locations. It consistently detracts from the stable, licensed NFO core. For investors, it just looks like a continuous misallocation of capital.
So management has outlined a specific financial solution to address these high operational costs. What's the plan?
They're focusing on 2 things. First, just general, stringent cost management. But second, and more strategically, they're using internal funds for UK land acquisitions.
Ah, okay. The goal is to replace those high annual lease payments with owned property.
Precisely. They are shifting an operational expense, that high recurring rent, into a capital investment, which is owning the land.
And how does that help them structurally?
By owning the land, they can structurally eliminate the massive cost of UK rent over time. Now, it requires high initial capital expenditure, but eventually it reduces the operational expenditure that's been contributing to these persistent quarterly losses.
So it's a long-term play.
It's a long-term deleveraging of their operational cost structure. And analysts view it as a rational move, provided, of course, that the land acquisitions are executed at fair value.
And speaking of fair value, let's tackle the elephant in the corporate room: governance and capital allocation. the final big investor question?
This is a qualitative but deeply significant risk factor that impacts trust and ultimately valuation. Analysts remain wary of revisiting governance and transparency issues related to what they deem high-priced related party property acquisitions, or RPTs.
Let's clarify for the listener what an RPT is and why it raises a red flag, even if it's perfectly legal.
A related party transaction, an RPT, happens when a company buys or sells assets or services to another entity controlled by the same ultimate owner.
In this case, companies linked to Tan's Free Vincent Tan.
Right. While they can be legitimate, they raise governance concerns because they bypass the typical arm's-length competitive bidding process. The concern is whether the price paid for the asset truly maximizes shareholder value for SPTOTO, or if the benefit flows disproportionately to the related party selling the asset.
And what specific example raised analysts' eyebrows here?
Analysts have cited one instance of an acquisition from a related party, Berhad asset, at an extremely high valuation of RM 15,211 per square foot.
15,000.
The sheer price point suggested a valuation premium. And when management offered a rationale for these RPTs, citing investment in income-generating assets and future appreciation, that rationale was explicitly deemed unconvincing by multiple analysts.
Unconvincing. That's a strong word from an analyst.
It is.
And this feeds into broader concerns about management independence, doesn't it?
It absolutely does. Concerns exist regarding the tight controls exercised by Tan's Free Vincent Tan over the company and its sister companies in the Berhad ecosystem. It raises questions about board independence, potential conflicts of interest. Right. So when analysts incorporate a governance discount into the stock valuation, it's because these RPTs and control issues introduce a risk. The risk that capital decisions are not purely aligned with maximizing SPTOTO shareholder returns. This uncertainty is a persistent force suppressing the stock price.
Okay, let's move to the most crucial point for current shareholders, the dividend policy. This addresses that key question on dividend reliability. Despite the massive Q1 profit plunge, what did the board do about the dividend?
For Q1, the company proposed a first interim cash dividend of 2 cents per share. This maintains consistency with the same quarter last year, which, at face value, is reassuring.
But we have to view this in the context of the recent dividend cut, right?
Exactly. The total dividend for the full FY 2025 fell to 8 cents. That resulted in a 45% payout ratio, which was a sharp reduction from the 61% payout ratio we saw in FY 2024.
So that reduction was a clear signal they needed to conserve capital.
Yes, likely due to earnings pressure and their debt commitments.
So the core question for investors is, was that 45% payout ratio a temporary measure, or is this the new, more conservative normal? Because that would drastically alter the valuation case for this stock.
Well, analysts are betting on a recovery. The consensus forecast is a recovery in the dividend to between 8 and 10 cents per share. And crucially, they expect the payout ratio to bounce back toward that 70% plus range by FY27.
Okay, so the market sees last year's cut as a temporary anomaly.
It seems so. And if this recovery holds, the commitment to a resilient dividend profile remains the major draw, forecasting a highly attractive yield around 7.1% for FY27.
A 7.1% forecasted yield 2 years out is a strong incentive to wait out the volatility. But if the dividend recovery is so clear, why isn't the stock price taking off?
The market skepticism is still very high because of all the issues we've talked about. The consensus leans strongly towards hold or neutral. Target prices are modest, hovering around RM 1.43 to RM 1.55. When the current trading price is already in the RM 1.36 to RM 1.46 range, it's near those targets, which implies very limited short-term capital appreciation. The stock is basically priced for flat growth and income generation, not for a major re-rating.
And that cautious rating is entirely justified by the earnings forecast for the near future.
Absolutely. Analysts expect a decline in net profit for the full FY 2026. This prediction stems directly from the two factors that dominated Q1, the increased volatility from prize payouts and the continued financial drain from HR Owen. It's just hard to forecast upside when two major structural liabilities are so clearly realized.
So despite all of that, what are the top levers, the key catalysts that could potentially provide some genuine upside for the stock?
We've identified 4 major catalysts that investors should be watching very closely.
Okay.
First, a shift back to favorable luck cycles. If SPTO can benefit from a period of low prize payouts combined with a high jackpot, that perfect storm we saw briefly last year, that would strongly boost short-term earnings.
Right, the luck factor again. Second, success in securing more than 8 special draws for 2026. This is that direct regulatory lever. each special draw is a highly profitable revenue event.
Mm-hmm.
Third, the success of the HR Owen cost reduction strategy. If those internal land acquisitions start translating into substantially reduced operational costs, the HRO segment could move toward break-even. That would remove the group's biggest anchor.
And the fourth.
And fourth, the actual materialization of that anticipated recovery in the dividend payout toward the 70% plus ratio. For income investors, this is the ultimate validation of the hold for income strategy.
Okay, let's tie everything together. In our last deep dive, we assigned a financial moat score of 6 out of 10. Based on this Q1 report, which basically saw every single downside risk we flagged come true,
Right.
does that moat score change?
The score remains a 6 out of 10. And this is perhaps the most important takeaway about the stock's fundamental structure. The score stays at 610 because while the structural challenges persist and were vividly demonstrated, the underlying core strengths of the licensing business are still undeniable and incredibly powerful. So let's revisit those strengths. What gives SPTOTO that 610 foundation despite all this chaos?
The strengths are the foundation of the cash machine. First, that licensing monopoly. It provides a high barrier to entry and resilience in the legal market.
Right?
Second, the core NFO business, despite the volatility, generates robust underlying cash flow over the long term. And third, this reliable long-term cash flow is what structurally supports that attractive dividend profile, which is why people hold the stock.
But the weaknesses are just as powerful and, as Q1 confirmed, highly detrimental. So why isn't the moat score higher?
Well, the weaknesses are constantly eroding the value of that license moat. They include the massive illegal gaming competition, that RM9B leakage we talked about. Then there's the high operational volatility, which the 63.4% payout ratio demonstrated so dramatically. You just cannot predict quarterly profit. And finally, that persistent non-core liability from the loss-making HR Owen segment, diverting capital and focus away from the core. So the 610 reflects the ongoing siege of a strong moat by both external and self-inflicted wounds.
And this leads us directly to that great historical puzzle of SPTOTO. The stock has been on a downtrend for over a decade, dropping from RM4 in 2013 to RM1.36 today. What's the fundamental cause of that persistent value destruction?
The decline is directly attributable to the confluence of three unrelenting, persistent problems. First, stagnant revenue growth. The overall group revenue has been relatively flat for a decade. A stock cannot appreciate without growth.
Right.
Second, the massive structural leakage to illegal gaming, which prevents them from capitalizing on their monopoly. And third, the extreme profit volatility, demonstrated again in Q1. Investors simply cannot tolerate a decade of flat revenues combined with unpredictable profits and persistent governance risk.
So given all of that, let's issue our final investment ratings. We'll start with the new investor, someone thinking about buying SPTO shares today.
Our new investor rating is a 2, which is avoid or a low buy. The justification is weighted heavily toward risk mitigation and opportunity cost. While the forecasted dividend yield of 7.1% is attractive, it is 2 years out and it's dependent on that earnings recovery. The short-term earnings outlook is negative. The stock lacks meaningful long-term growth, and it's subject to extreme profit volatility and those non-trivial governance concerns. For new capital, there are simply better, less volatile opportunities for income out there.
And second, for the existing investor, someone already holding shares maybe at a higher price, should they sell, hold, or add?
For the existing investor, our rating is a 3, which is a hold. The logic here is pragmatic and income-focused. Selling at a loss crystallizes the capital depreciation that's already happened.
Right.
If the investor's goal is pure income, the forecasted dividend recovery to that high yield offers a strong, compelling reason to hold. This is contingent, however, on the core NFO cash flow remaining structurally sound enough to cover the dividends and debt payments.
Which the deleveraging plan supports.
It does. However, adding more shares is not recommended due to the high structural risks, the confirmed profit volatility, and that Q1 shift to negative operating cash flow, which indicates that short-term downside risk is still very, very real.
Okay.
So, to summarize this deep dive, we've seen a quarter defined by the extreme volatility of the luck factor. A highly unfavorable 63.4% payout ratio just instantly erased NFO's sales gains and decimated quarterly profits, confirming the severe operational risk we've been flagging.
And that was compounded by the critical, worrying swing to negative operating cash flow.
Exactly, suggesting immediate pressure on working capital. Management clearly faces significant work ahead to stabilize the balance sheet, address governance concerns, and somehow mitigate that HR Owen drain.
Indeed. Given that analysts are incorporating a governance discount due to concerns over those high-priced related party transactions, and the stock is hovering near its conservative hold targets, the final multi-million ringgit question for you, our listener, is this. Does the anticipated dividend recovery that promised 7.1% yield 2 years out truly justify navigating the immediate high volatility, the negative cash flow shock, the massive leakage to the illegal market, and the persistent governance risks that continue to suppress SPTO's fundamental value, holding it so far below its historical high?
A very good question.
Thank you so much for tuning into this deep dive. We truly appreciate your time and your engagement with this complex material. If you found this analysis valuable, please take a moment to like this video, comment below with your thoughts on SPTO or any other stocks you'd like us to cover, and hit that subscribe button. We'll be back next time with another deep dive.